Welcome to The Explainer. You know that feeling? Your portfolio's looking great, you've got some solid gains, but there's this little voice in the back of your head saying, this can't last forever. Well, you're not wrong to think that. Today, we're going to break down a really smart strategy to protect those gains, especially when the market feels a little too quiet.
So, let's kick things off with the big question, and it's super relevant right now. You're looking at the India VIX, which is basically the market's fear gauge. When it's high, people are nervous. When it's low, everyone's feeling pretty confident. And right now, it's been hovering at a long-term low. But as anyone who's been around the block knows, that kind of calm, well, it rarely lasts.
Okay, here's our game plan. We'll start with why a storm might be just over the horizon. Then we'll get into the tough spot investors find themselves in. After that, I'll introduce you to something called portfolio insurance. We'll actually crunch the numbers, see how it holds up, and then figure out if this is a tool that makes sense for you.
Right, so let's talk about this coming storm. We just saw that the market's fear gauge is super low. Everyone seems to be pretty relaxed. But what's really going on under the surface? You know, when the VIX gets this low, it's a huge signal of complacency in the market. And if you look back at history, these super quiet periods, they're almost always followed by a big burst of volatility. It's not a matter of if things will get choppy, but when. And that forces a really tough decision for anyone sitting on some nice profits.
So, the market starts to feel a little shaky. What's your first gut reaction? For most of us, it's that temptation to just hit the sell button, right? Lock in those profits. But it's not that simple. This creates a really painful dilemma. And here is the classic trap. On one side, you can sell. Great, you've locked in your gains. But you're immediately hit with a guaranteed tax bill, and you might just miss a huge rebound. On the other side, you hold on tight. You avoid the taxes, sure, but you're risking watching all those hard-earned gains just disappear in a downturn. Neither one of those feels very good, does it?
Let's really drill down on the cost of selling, because unlike market risk, this is a guaranteed loss. In India, if you've held your investments for over a year, a pretty big chunk of your profit goes straight to the tax man.
We're talking about the long-term capital gains tax. The way it works is pretty simple. Your first 1,25,000 rupees in profit is exempt. Anything over that gets taxed. So let's make this real with an actual example.
Okay, let's say your portfolio has had an amazing run. You turned 5 lakhs into 10 lakhs. That's a 5 lakh rupee gain. Congrats. Now take away that exemption and your taxable gain is 3,75,000. And the tax on that amount
Is almost 47,000 rupees. Ouch. That is the very real, concrete cost of selling. That's money that is just gone, handed over, simply because you wanted to play it safe and get out of the market. So if selling has such a high guaranteed price tag, is there another way, a smarter way? You bet there is. Let's talk about the idea of portfolio insurance. The answer is a strategy called hedging, and we can do it with something called index options. Now, the best way to wrap your head around this is to think of it exactly like buying insurance. But instead of insuring your car against a crash, you're insuring your portfolio against a market crash.
But insurance is never free, right? There's always a premium. So the big question becomes, is the premium for this portfolio insurance cheaper than the guaranteed tax bill you'd pay from selling? Let's run the numbers and find out.
So how do you buy this insurance? Well, instead of selling your stocks, you buy what's called a Nifty put option. The Nifty index is kind of like a proxy for the whole Indian stock market. Buying a put is basically a bet that the market will go down. So in this example, with the Nifty at 26,200, we'd buy an option right at that level. The cost, our premium, is 200 rupees per unit, and they come in batches or lots of 75.
And if you do that quick math, the total cost to insure your portfolio comes out to just 15,000 rupees. That's it. That is the most you can possibly lose on this insurance policy, and it protects your entire portfolio for a set period of time. Now this is the light bulb moment. Look at that difference. The guaranteed cost of selling, that tax bill, is over 46,000 rupees. The cost to hedge, just 15,000. You can protect your entire portfolio for less than a third of what it costs to just cash out. That's huge.
Okay, so we've established it's way cheaper. But the real question is, does this insurance actually work when you need it? Let's walk through what happens in a few different scenarios. This table really shows you the magic of it. Scenario 1, the market falls. Your portfolio loses value, but your insurance policy, that put option, gains value, helping to cancel out those losses. It does its job. But here's the beautiful part. What if the market goes up or just stays flat? Well, you're still invested. Your main portfolio grows or stays stable. All you lose is that 15,000 rupee premium you paid for the insurance. And in either case, you are way better off than having paid that 47,000 rupee tax bill.
So let's zoom out. What's the big idea here? What's the one thing you should really take away from all of this?
Look, this isn't for absolutely everyone. If you have a smaller portfolio, the cost might not make sense. But for investors who have built up substantial long-term gains, this is an incredibly powerful tool. And it's important to remember, this is a defensive move. It's not about making a profit. It's about giving you the confidence to stay in the game and avoid making emotional, costly decisions.
And really, that's what it all comes down to. Hedging is just a structured, disciplined way to manage risk. It buys you peace of mind, it stops a moment of panic from completely derailing years of patient investing.
So I'll just leave you with this final thought to chew on. You insure your house, you insure your car, you insure your health. But when it comes to your financial future, is your portfolio insured?